You've said this morning that you're in two minds going into the June FOMC meeting. Are you leaning further towards one of those minds or the other, or are you split down the middle?
Well, I tried to raise two possibilities. One is my modal expectation going into the meeting. I'm expecting economic conditions have improved. My outlook looks like it's coming around pretty nicely, and I expect that it'll be appropriate to raise the funds rate twice in 2016, so that by the end of the year we'll be in the range of 75 to 100 basis points. So that's what I would expect would be the case. Unfortunately, I think that it's going to take 3 years or more to get inflation up to our 2% objective. And so what I tried to lay out in the speech is, well, what if we thought it was even more important to get to 2% inflation sooner and solidify firmer inflation expectations, which have been lower, that are a little bit below our 2% objective, I think. And so there might be some value to think about holding off until we got core inflation up to 2%. That's not what I expect policy to be, but I think it's worth focusing on getting inflation expectations up and more consistent with our objective.
Can you see a situation where the U.S. allows the economy to run hotter then, allows inflation to get higher before hiking rates, and doesn't do those two this year?
Well, I think that, my outlook for the economy is, for about 2 to 2.5% growth going forward. That's pretty good growth. That's above trend at the moment. And so that's running, I wouldn't say it's hot, but it's running pretty well. I would say it's most likely if we didn't raise rates the 2 times that I'm thinking, it would probably be because there was a downside risk of some sort. So I'm kind of thinking that the data are coming in pretty well, and by the end of the year, 75 to 100 basis points on the funds rate for the range is about right.
We've got the payrolls data. You mentioned the data. Payrolls due out later on today. How will you be adjusting those numbers? When you look at them, people will be trying to work that into your June, July decision-making process. How will you look at them? Because there's so many one-offs, the Verizon strike, for example. Will you be adapting that data, adjusting that data in your models to give you a cleaner picture?
Well, I guess that's right. I mean, there are likely some effects like the Verizon strike that you're talking about, so that might knock it down a little bit. I think, though, I'm looking for good payroll employment growth. We've averaged over 200,000 for the last 2 years. Last month was 160. We'll look at the adjustments and see how it is, but I'm expecting a good number.
Can you give us clues as to how you would adjust for those kind of effects? Because people are asking themselves whether it's possible to get a clean number this month, and if it's not, does that take June off the table?
Well, I think we've seen a lot of cumulative good progress in the labor market, so I wouldn't get too excited about any one number no matter what. And if there's special factors, that makes it even more difficult to assess that. So I do think that there's a lot of value to allowing enough time to monitor the situation, especially if you think that things might be changing a little bit. So that might be one rationale for holding off. Look, I don't think that the timing for our rate hikes is important. It's so much. I mean, if we were to move in June, that could work. July could work. September could work. I think that with my outlook, 2 hikes in 2016 could be appropriate. Timing is just something everybody's always interested in, but, you can't know until you get to the meeting.
You can't know, but if you're going to do it in July, you might have to call a press conference. Would that be the case?
Well, that's right. So Chair Yellen has 4 press conferences a year, and it's June and September would be the timing. July, if we did it, we've tested that on short notice she can get people on the phone and explain what our decision is and take some questions. So it's not a problem at all.
I'm sure she wouldn't have a problem filling the room. Let's talk about how the markets are positioned for the summer, because we're talking about sort of mid-20s expectation, the percentage this is, expectation around a June hike, and it gets over 50% when you look out to July. That's not a nailed-on certainty, though, in the markets, and that might be the correct positioning. Can the Fed move if we don't have a higher percentage expectation of a rate hike?
Well, I think we've tried to be as clear as we possibly could be that, we've got an outlook. We think inflation's moving up. We have more confidence than we had before. Those are the conditions. The data have rolled in reasonably well so far. And so the expectation from the 17 participants is it's likely there will be 2 moves this year. So one could be in June, one could be in July. I think the markets have heard us. I think that Chair Yellen's comments in Boston the other day helped solidify that. But sure, if we think it's appropriate to move, we can do that.
Yeah, so the markets mismatch with the dots, that wouldn't stand in the way of moving policy?
I don't see anything that's particularly troubling, and I think that everyone will catch up. And we're not talking about such a substantial move that it should be a big surprise either way.
We're here in London, a bit chilly for this time of year, for which I apologise, Charles. Let's talk about the upcoming EU referendum, or Brexit debate as it's colloquially known. Citi putting out a note this morning saying that they think that actually the Brexit decision could be more influential on the Fed in June than this payrolls report that we're waiting for. Is that a good measure of the magnitude of this event that's happening here in London?
Well, this is adding a lot of uncertainty to the global economic environment, and there's already a lot of uncertainty with global slowing around the world. The U.S. has a pretty strong economy right now, and the question is sort of, are the conditions right where we could take another step in terms of tightening? I think we'd like to, have a resolution of as much uncertainty as possible, and so the Brexit vote does get in the way of that. But that being said, I think we're going to focus on the U.S. economy, financial conditions, whether or not the global environment is imparting already too much financial restrictiveness so that we wouldn't need to move that quickly, but it could be that things are just fine.
What's the concern around Brexit? Is it just around a short-term volatility in markets, or is it a long-term concern for the growth of the UK economy? I mean, the Bank of England governor has said a Brexit could send the UK into a recession.
Well, I just think that, from my perspective, this is just a very big unknown. It's not my country, it's not my economy. So I'm listening to everyone's opinions on this. It certainly does suggest that there's so much uncertainty. It would be difficult for anybody to take a substantial investment decision ahead of that vote, even afterwards, if it were. Depending on the situation, the next 2 years could be a very difficult time for making decisions. So I can understand some of those comments that you've alluded to.